Hello, Money Multipliers, and welcome back to another episode of the Money Multiplier podcast. I'm your host, Hannah Kessler, and again, I'm joined here with my friend, my colleague, also my mentor as well, Jonah Dew. So, Jonah, how are you doing today?
I'm doing fine. Kind words, Hannah. Kind words. Thank you this morning.
So anyways, actually I didn't ask you, we're talking here. It's on Wednesday, what I call hump day. What do you got going on today?
Lots of helping folks today. Actually, I think I've got a full slate on my calendar, completely booked up today. Maybe a few open areas. So I'm going to be on the phone a little bit today, helping lots of people talk about their policies, answering lots and lots of questions. So Wednesdays are generally like that, midweek. I guess most people, maybe on Monday they formulate a question. By Wednesday they want it answered. So they can start implementing something by the end of the week, maybe. But yeah, that's what my day looks like today specifically. Actually, I do have one other thing to mention. We had talked a little bit earlier in an earlier episode about some of the uses we were doing with our cash value.
Mm-hmm.
And I had mentioned that I had done a private lending deal previously. So actually today, I was told yesterday, I'm supposed to be getting that payment back today. It's a certified check showing up in the mail. I got to sign for it. So no lunch meetings outside of the house today. Today's getting a private lending deal kind of back. So that's also super fun.
That's nice. That's nice. Actually, to kind of go on that topic, on Monday this week, I just took out another chunk of money from my policy and I put it into a 10% investment, a private lending deal. So I'm right there with
Nice.
you. I'm waiting for my return checks though now.
There it is. There it is. That's very cool. Yeah. So I'll make sure I'm here all day, and I'll be waiting for the mailman. It's I'm like a kid again. Every time the truck drives by, I run to the door and see if it is it the check. Is it back? But
And actually, we'll get into that too, because as when you said that, it put the thought in my mind about how Dad, when we go out and we teach this live and do live seminars, so my father, Brent Kessler, he'll get up in the room and one person they'll ask the question of, well, when do I stop paying my premium? And Dad always goes, well, if we're good coaches, you'll understand why you never want to stop paying that premium. Because I'm in my boxers doing a little happy dance at the front door when the mailman comes by saying, hey, Brent, your premium's coming due. So it's a good segue into really our topic today of, should you put all of your income into a policy? Should you put your monthly bills and monthly expenses, and should that go into the policy premium? So that's really the topic that I wanted to cover here today. And why would you want to do it? And why would some people say it's not good to do it? So, Jonah, do you want to lead us off? Do you have some initial thoughts you want to cover first?
yeah, thank you. I think we should backtrack just a second and let the folks know exactly how someone would come to this question, right? So a lot of times when we are getting folks started with the infinite banking concept, we have done maybe a live presentation in front of a room, or of course we have a recorded one that folks can watch on the internet. But afterward, if they want to get started, we've kind of made it a habit over here at the Money Multiplier to let that new person decide what their premiums are, right? We don't actually go out and tell them, okay, Hannah, you saw our information. That's awesome. You should deposit $50,000 into the policy. You ready to go? Right? Because we don't know if you've got that. You know what I mean? And you can put in anything you like. And of course, if you understand well, you'd put in as much as you can. But at the same time, we're not jumping into your personal finance from the get-go, from the offset, to be able to tell you exactly what that premium is. So sometimes folks who are really thinking and really want to get the policy to maximize and work for them ask this question, right? What about if I put in my whole paycheck every week, every 2 weeks, every month? What about if I did all of my income right away into the policy? So yes, I have some initial thoughts, and I've got initial thoughts on a couple different levels. So I'll say one or two. I'll let you jump in and say one or two, and then we'll come back and we'll dissect them all. Does that work?
Cool.
All right, cool. So my first initial thought is, yes, that's an awesome idea. That's an awesome idea. I think Nelson's got something in his book to say about that. We'll read that just in a little bit later. But the first thing that you should be aware of is that once you put all of your income into the policy, we are going to use the cash value in order to pay things, pay expenses, pay bills, buy new things. And so, because the cash value first year, this is specific, I'm really only talking about first year, right? But because the cash value is not equal to the premium in the first year, if you were to put your entire paycheck into your brand new policy, you are in related terms taking a pretty big pay cut because you're not going to have all of that money dollar for dollar coming out of the policy in cash value right away. And so if you are the type of person that, I'll throw a number out here. If you make $5,000 a month, $60,000 a year, and you decide to put all 60,000 into your into your policy, your brand new policy, your cash value is going to be 30, 40, 45,000, right? Does that make sense?
Yes.
It'll be not dollar for dollar, not equal to your premium deposit. And so really a lot of people aren't set up to live that way. A lot of people aren't set up to take a 10 to 15 to $20,000 pay cut and still make it, right? And still pay all their bills. So while that's a worthy goal, it's not somewhere you normally start. Hannah, what do you think?
No, I agree with you. What I would say is I agree, right? So, like when I first started getting into this stuff, I did not have and I did not put my full income into policies. At the time I was just a waitress, and really I just started my first policy at 5,000 a year. And obviously I was making more than 5,000 a year in premium or in income, excuse me, in income. But I do agree that as time goes on, you can reach that goal to have income to equal premium. So Nelson tells us it takes an average of 15 to 25 years to reach this goal. So it's not the first onset thing of what's going to happen. So here, I'll read from Nelson's book, Becoming Your Own Banker. It's on page 48, and it's the first section of how he opens this section of expanding the system to accommodate all income. So Nelson says, it always sounds a bit strange to people when I say premiums and income should match. Let's start with the very basic fact. Doesn't all your money go through somebody else's bank now, meaning Bank of America, Wells Fargo, etc.? When you get your paycheck, what do you do with it? Right. You deposit it in somebody else's bank. Then you write checks against it to buy the things you want in life. While it is in the bank, the banker lends your money to someone else and makes a good living doing it. So essentially what Nelson is saying here is that, you do want to reach that point to have all income running through the policies first, because you now are going to be that own banker in your life where you're lending it back out to you or to somebody else to buy the items that you want to purchase in life. So like I said, it's not on the forefront. This is how we're going to start it, income into policies right off the bat. Now I will play a little devil's advocate, because Dad has told me before, well, Hannah, if somebody is bringing in 60,000 a year, but they got $1 million, $2 million sitting in the bank, then maybe it is okay if they start this policy with 60,000 going in the first year. But those are those rare scenarios, right?
Yeah. So I absolutely agree, especially with the little caveat. If you've got more than that dollar amount, your annual income sitting somewhere else, and again, it doesn't have to just be sitting in a bank. We've got lots of people who have decided to start policies with money that they had sitting in other places, right? Sitting in
Mhm.
qualified plans or sitting in equity in their home. So we've got lots of people who decide that, but there are some rare cases where it does make more sense, of course, to start a policy that way. So yeah, and of course, if that's you, we'd kind of walk you through it, right? We'd walk
Yes.
you through it. Now, here's a kind of a follow up question that I've got for you, Hannah, because this sometimes is literally like chasing our first question, right?
Yeah.
First question: should I put my whole paycheck? Should I do my whole premium in there? Generally, we're going to give the same answer. Everyone around here is going to give the same answer. While it's a goal you want to hit, while that is the end goal, that's just not normally where you start. Just like you said, Nelson says it's going to take us 15 to 20 years to get there. I'm only, I guess my oldest policy is 6 or 7 years old now, and I'm not there yet, right? I do not have my full income in policy premium. I do have more than one policy. I do actively start new policies, but it still is not equal to my entire premium as of yet. So that's a goal I'm still working toward.
Yes.
Now, but here's the follow-up question that's like shortly thereafter most of the time. Most of the time they're going, okay, the reason I wanted to put all of my money into premium is because I really wanted to stop using my own money to pay like my expenses and stuff. I really wanted to start using cash value to pay for my power bill and my Netflix and my gas and my groceries. I really wanted to do that. I heard we could do that. That's what I wanted to do. That's why my initial thought was, let me put my whole paycheck in here.
Yeah.
Hannah, what are your thoughts on someone who follows up with that type of question right away?
Yeah, yeah. Their thinking is not off, in my opinion. I think they're doing very well with the creative thinking of how they can implement their banking policy in their life. However, in my opinion, I think there's better use for that money. I am not saying that you cannot use the policy to help pay for those monthly expenses. However, in my opinion, there's better ways to use that money. So right, like I would rather use that money to go out and pay for a large expense of an item, whether it be like Jonah. I actually remember when you were coaching me when I got into this about 5 years ago. I remember you had a surgery. You were playing basketball or something. You hurt your leg and you had the surgery. And you
That's
said,
right.
well,
Yep.
and I was talking to you about the same topic. And you said, well, hey, I would rather use my policy money to pay for the surgery, that larger bill item, rather than my $15 a month phone bill. So those larger ticketed items and investments is what I think that you should start off by using the policy for. Now, later down the road, though, because I'm sitting over here, I will definitely take out a policy loan. If I rack up a high credit card bill that month, I'll use my policy money to help pay for my credit card expense that month. Absolutely. I've done it before because as time goes on, right, inside of the policy, our borrowing power becomes stronger and stronger. So we are going to get to that point where you put in $1 into the policy, that policy is going to be growing by $1.50, $2 now later down the road. So then, yes, in that instance, when I'm in my efficiency years, then I don't find a problem with using the policy money to help pay for those monthly expenses. However, in my perfect world, I would rather have my income investments pay for my monthly expenses. That's where my thought process is coming from.
I love that. I love that answer. A lot of times, people ask us as well. They say, it's really tied into the question. They say, well, if I am using the money from my policy, I know that the insurance company is going to charge me some interest to use that money.
Mhm.
So, kind of the school of thought where we're coming from is, again, you can use your policy to pay for your expenses, but you're using a policy which will charge you a little bit of interest to pay for an expense that didn't have interest attached to it at all, right? You don't have interest on your power bill normally and your Netflix and your car insurance, right? So you're using a policy loan to pay for something. Again, they're going to charge you a little bit of interest to pay for something that didn't have any interest attached to it. So you're kind of incurring an interest charge now. And then you, of course, to be your own banker, you want to repay that policy loan with extra as well. So if you took $100 for the phone bill, you actually want to put $105, right? $110 back in your policy. That's becoming your own banker. And then you, of course, got the interest charge from the insurance company at the end of the year. So you've actually incurred just a little bit of cost by using your money, your policy loan to pay for the expenses. Where at the same time, you could use your policy loan to pay off interest bearing accounts, interest if you have debts to pay those off. Or of course, like many of us do around here, like we was just talking about at the beginning of the episode, we use those policy loans to go make more money, right? In some sort of private lending deal or some sort of plan or account, whatever you like to do, whatever you have going on. So again, I've got an interest charge incurring from the insurance company to borrow the money, but I just went and put that money into a private lending deal that's going to turn around a few $1,000s for me when this all pays out, right? So the amount of interest that I am charged is minuscule to the amount of money that I just earned.
Yes.
Now, some people say, I just actually recently got this question maybe once or twice, even in the last week, but they say, well, if the insurance company is charging me this much, 4 or 5%, but I can go get money from a bank at 1 or 2%, why use the insurance company's money over the conventional bank's money, right?
Good.
So I think there's really two schools of thought to that question and answer. The first is the financials, the dollars, get a calculator out and add it up type idea. And the second is when we talk about control. So Hannah, I'll talk about the numbers if that's all right. I want you to talk about control. What's your take on control? Should I use a regular bank or should I use my policy?
Good question. The answer, it depends on how honest and how disciplined of a banker you are. In my personal opinion, if I can go down to the bank and get a loan at 2%, 3%, I'm okay to use the banker's money. However, I need to understand that I am now in debt to that banker. So if I'm not putting that money to use, or if I'm not paying back that loan to the banker, they're going to come and seize that collateral that I went out and I gave them so that I would promise to return that loan back to them, right? So if the bankers don't care if I have a tough month, if a family member passes away and I'm out of commission for a month or so, right? The bankers don't care about that. The bankers just care if they get their money. So in my personal opinion, I know myself, and everybody should know themselves. You do not know anybody better than how you know you. And so I know myself, and I know that I am disciplined with my money, that I'm okay to go down to the bank if they're handing out deals for great rates and using that money to go and further capitalize on and to further leverage and build what I'm doing over here. Now, however, like I said, the control factor though, you have complete total control inside of the policy when you're not involving the banks in your life, right? What I mean by that, and what we teach and preach all day long, is that policy loans are never required to be paid back to the insurance company. The principal of the loan is never required to be paid back. Even the interest on the loan is not required to be paid back. However, we always tell you must. I tell you must, but I always say you should always pay back that loan interest. So now, if I'm using my policy loan money, right now it's 5% simple interest to go out and use that money. However, I'm in control. Who cares if I don't pay myself back, because Hannah's not going to come and repo her own car off her own lot, right? So I'm the one in control there.
I like that answer. I like that answer a lot. A lot of people don't put as much value in control, right? We live in this kind of, and it's just human nature, but we live in this kind of, oh, everything will be all right type scenario, and never thinking that tomorrow something could go very wrong. And so being in control of the situation, of the deal, of the financing is huge. I would much rather be in control, especially when you talk about interest costs and paying things back. When you think of it over long term, we would go out of our way. I know hundreds of people who would go out of their way to go get a loan at 4% instead of 4.5%, right? I
Yeah.
want the 4 instead of 4.5. But when you really think about it over the course of a 10-year period, a 20-year period, we're talking about a few $100s for the fact that you can have control the whole
Mhm.
time. I can skip months. I can have bad months. I can decide to give money to my family or friends if they're in need and come back to my payment a little later. All of that stuff, right? Because I'm in control. So the other aspect that I said I was going to talk about is just the dollars and cents, right? So there's two things here that I want to just touch on. The first is, sure, go use that money from the bank if the bank's offering a lower interest rate or percentage rate. But reminder that it only makes sense, pun intended, it only makes sense if you've got enough money somewhere else that's earning, right? You've
Yes.
got $0 in your pocket. You go down to the bank and get a loan. You're just incurring yourself a charge, right?
Yes.
It's the fact of we're saying you can use the bank's money or the insurance company's money when you choose, as long as you've got money somewhere that's earning. It can even be earning at a lower interest rate or a percentage rate if you've got longevity there, because over time it will grow higher than the interest cost you'll incur while you pay back your loan. So
Yeah.
don't forget that. So it's still starting with I've got a policy and premiums paid and it's earning for me and I'm going to get dividends, and then I'm deciding which money to go use. Doesn't make sense to take the money out of the system that's now paying you. Where should I get the money from? Whether it's a cash value loan or whether it's from the bank. If I'm disciplined and I'm going, listen, I'm going to take the money out, I'm going to go put it in this deal. The deal's going to pay me back in a year and I'm paying this thing off. Well, then I might go take it from the bank as well if they're offering great deals on the
Mhm.
money, right? If the rates are right. But at the same time, if I'm going, my life might get a little tough. I got kids going to school. I got family coming in town. I've got, cars kind of on its last leg, whatever it might be. I'd probably still choose to use the money from my policy instead because
Agreed.
I've got the control. If something happens, I've got time, I've got space, I've got the ability to adjust things before I keep moving. And no one's coming to get my car or foreclose my house, right? Because I used my policy to do that. So
Good.
all of those questions relate really closely to that original thought and idea. Should I put my whole paycheck in my policy? And again, we did dive a little bit off topic, but really it was because these questions are normally followed up, right? I wanted to put my full paycheck in because, and that's really what we wanted to dive into in today's episode.
Good, good. And actually, it kind of brings me back to, because some people will say, well, hey, Nelson Nash's rule number 4 is don't do business with the banks. So let's just touch on that for 1 second here, because so I agree, right? And we all got to understand where Nelson came from, his time of when he was here, and the decades that he has lived. So I agree, you do not want to involve the bankers in your life because you are losing that control factor of it. So I hope we hit that one, the nail on the head there. So I'm good. I have no other thoughts to share on this topic. Please, if you have more questions and you want to dive in deeper into this, and this topic has sparked even more questions, reach out to us. So you can find us on themoneymultiplier.com, and you can email us there, call us there. We're an open book, as Jonah says. So Jonah, what are the events that we got coming up?
Yeah, we've got a few. So you'll have to forgive me. It's either I know that your dad is in Ohio currently. Is that right?
Actually, yeah, no, just came home last night.
Just came home last night. Okay, so Ohio. If you're in Ohio, you have just missed our latest live banking presentation. But still, reach out and let us know you're there, so that way maybe we can invite you for the next one if you're interested. But as far as upcoming events, I believe this Saturday, which is July 16th. Brent Kessler himself will be in Atlanta, Georgia, or actually Stone Mountain, Georgia, and I'll actually be there with him. So it'll be Brent and Jonah. So if you're interested in meeting us, seeing us, and you're in or around the Atlanta, Stone Mountain, Georgia area, that is where we'll be this Saturday, 10 a.m. for a live banking presentation. Of course, we've got Hannah still headed to Gilbert, Arizona on the 28th of July. Is that right?
That's right. That's right. And even before that, though, July 23rd, so the following Saturday, not this Saturday, the following Saturday. If you're in Florida with myself, we're here in Daytona Beach. I'm driving a little bit south, and I'll be speaking in Fort Lauderdale. So if you're in the Fort Lauderdale area, you just let me know if you'd like to attend. I'll get you in.
That's awesome. So Saturday, July 23rd, Fort Lauderdale, Florida. That is July 28th, which is a Thursday, Gilbert, Arizona. Now, July 29th and 30th will be Buffalo, New York. That'll be Chris Noggle, Brent Kessler, Hannah will be there, and that will be a in-person boot camp event for those 2 days, July 29th and 30th. as well. And I believe those are all of our events that are lined up right now for the month of July. As we get more events and as folks ask us to come and speak to their audiences or speak to their families and friends, we will, of course, let you know. Those are the events for July. We would love to see you there if you're around the area in any of those towns. Just reach out and let us know. And of course, same as we asked you previously, if you've got topics that you would love us to discuss, reach out. Reach out and ask, submit those topics. We'd love to answer them on a next episode.
Awesome. All right. And don't forget, leave us 5 stars, comment below, tell us your thoughts on this podcast. We want to hear your thoughts, your ideas, your suggestions as we move through this and the wealth train moving down the tracks. And hopefully you're on this train with us. So, all right. Well, thanks for tuning in and we'll catch you next week. See you then.